नमस्कार साथीहरु, वेलकम अल अफ यु टु माई च्यानल। आजको डिस्कसनमा हामी चाहिँ डिफर्ड ट्याक्स र कम्पनीजको डेट एनालाइसिस हामी कसरी गर्न सक्छौं एज अ फाइनान्शियल एनालिस्ट या इभन दो यु आर अ स्टुडेन्ट अफ फाइनान्शियल अकाउन्टिङ। It's very interesting, friends. This topic is interesting, but at the same time challenging too when you are explaining the things about the what we understand by the deferred tax, and then as a, let's say, the financial analyst, how we are going to analyze the overall data position of the company. र आजको डिस्कसनमा हामी बेसिकली अब डिफर्ड ट्याक्ससँग रिलेटेड डिस्कस गर्नेछौँ। द्याट्स अल अबाउट द टाइप्स अफ डिफर्ड ट्याक्स and how we analyze the overall accounting equation, and at the same time how to analyze the firm's ability to meet its debt obligation. र पहिला के विचार गर्नु पर्यो भने साथीहरु चाहिँ डेट डिफर्ड ट्याक्स भनिसकेपछि इट्स भेरी इम्पोर्टेन्ट कन्सेप्ट फर financial and the tax planning. We say that, and so there is a need of accurate financial reporting and effective tax management. That is the basic reason we see that deferred tax play the eminent role. But the question is that why do the deferred tax arises? So basically we say that it represents the taxes that are postponed, or you can say that advanced to the future periods. So in this case, friends, that is why we say that because of your differences in the treatment of the income, yeah, expenses as per the accounting standard, yeah, tax law le garda ke huncha bhane we say that deferred tax arises. So you can say that it results from the differences in how the company recognize the income, yeah, how the tax authorities recognizes that income. So basically, friends, there are two types of we say that deferred tax. One is called deferred tax assets, र अर्को चाहिँ deferred tax liability. So let me clarify about, friends, what about the deferred tax assets. Deferred tax asset को लागि तपाईले यो पाँचवटा पोइन्ट सम्झिनु पर्ने हुन्छ. So that is the case of over payment or advance payment of the tax, yeah, which resulted from the differences in the tax rules and the accounting rules. Third is that reduce the company's taxable income. Yeah, fourth we can say that presents the financial benefits to the company. And the 5 is all about listed in the balance sheet as a non-current assets. Okay, that's a fixed asset, you can say that. This is for the deferred tax assets. Now what about the next case? That is the, let me clarify about the concept of deferred tax, how we solve the questions. So let's see, assume that based on the past experiences, the manufacturing company estimate that, yeah, the computers that will be sent back for the warranty repairs from the customer in the next years, which is 2% of the total productions, and its total revenue is the 5,000 and tax rate is 30%. So in this case, what would be the deferred tax assets? So you simply you have to prepare the income statement for the company at the same time to the tax authority. अब यहाँ तपाईले के गर्नु पर्यो भने, look at the simple case, that is the revenue we have of 5,000. While 2% of this value, we assume that whatever the company produce and sells it. So 2% of this value is our warranty expenses. So you would have a earning before tax is 4,900. So you would have a tax expenses is 30% of this value. So net income is 3,430. Okay. Now what about the for the tax authority here? Then look at this here. That's the case of revenue is 5,000. Well, we don't have any warranty expenses because the tax authority never provide you this type of facilities so that you could reduce the warranty expenses. Okay, so the taxable income will be the same. So what about the tax payable to the government here? So 30% of this value, that is 1,500. So net income is, we say that net income, yeah, you can say that earning after tax is 4,500. So in your income statement, simply we say that revenue minus expenses, and your expenses is 1,470 here. So net income would be negative, which causes equity negative. While tax payable is 1,500, and that is why we say that deferred tax asset is your 30. Now what about the concept of deferred tax liability, friends? Simply as I explained earlier, it resulted from the timing differences between the tax incurred in the tax due to be paid. We say that, yeah, obligations to pay the tax. For example, like depreciation expenses treatment as per tax law and the accounting law, and amount of the tax payable in the future. That is the concept. Now again, let's discuss about the second example. Let's see one startup company which begins the business on the January 1st, 2019, and it has sales of the 8,000, no expenses other than depreciation. Tax rate is 30%, and the company uses a straight line method of depreciation for financial reporting purpose, while tax purpose it has used the modified accelerated cost recovery system. However, the 4,000 depreciation in 2019, while each year reduction in 1,000 per year. So what would be your deferred tax liability in this case? Again, you have to prepare the income statement, friends. Like for the startup income statement, each year you would have a 2,500. So earning before tax is 5,500. Tax expenses. So you would have a 3,850 is the net income. While similarly in case of tax authority, depreciation for 19 is that 4,000. So taxable income would be now 4,000. Tax payable, or you can say that is the paid, is that is the 30%. So in this case, what we do here, friends, this is your 1,650, which is simply we say that as net income is negative, here your equity will be negative. Tax payable is 1,200, and deferred tax liability is that is we say that is the 450. So this way we could clarify the concept of deferred tax. I would suggest to all of you, you could take the reference of this book too. That is wonderful book. That is the Porter Norton Financial Accounting, the Impact on the Decision Makers, 9th edition, page number 513 to 514. So again, as I discussed earlier, is the same question, similar question you will find it. Okay. So this question, as for this question again, this is business started in January 1st, 2014. Again, the company uses sales is there, no expenses, blah blah, and there is a, we say that a straight line method has been used by the company, and the asset value is 10,000 for your life, and again MACRC methods for the tax purpose has been used, 4,000 depreciation. Actually, I've taken this problem as a reference while discussing the deferred tax asset and the deferred tax liabilities concept. Okay, so first question is about what was your depreciation amount for each of the 4 years, what about the tax payable, what about the tax expenses, and how we record the journal entry like that. This way you could prepare it as I discussed earlier. For tax purpose, first year, second year, third year, each year there is a reduction in the 1,000 as per this question, because being using the straight line approach, each year would be the same. So in this case, friends, you would have to prepare the income statement from the tax authority point of view. Okay, and again you have to prepare the income statement from the company point of view, where depreciation expenses is 2,500, and previously you can see depreciation expenses for this year is, that is 4,000. Okay, so that is the why we can say that when you prepare the journal entry, tax expenses account debit, tax payable account debit, with credit to deferred tax expenses, and similarly you could explain the things in the accounting equation, friends. And remember, you have to prepare you have to show your working note too. Since look at this one, this is, we have a negative, so your equity will be negative, and this way deferred tax is 600, friends. Okay, now the question is about how we analyze the company's ability, a firm's ability to meet its debt obligation. One of the ratio is that debt equity ratio. Like its long-term liabilities is one of the important component of capital structure, which is simply the component of the long-term debt, we say that. And as a must investor even analyze the firm's equity rather than debt, but even if there is a need of proper analysis of debt, I would say. And next one is that debt and its interest charges, which are the fixed obligations that must be repaid in the finite period of the time. That means if you are unable to meet it, that means there will be the, we say that debt problem, yeah, financial problem, we say that. But in contrast, we say that equity never has to be repaid. That means when you have an investment in the equity, yeah, a stock, the company will not redeem your value of your investment. So you are taking the more risks as compared to like your investment in the, we say for example, let's see the bond like that. Okay, and remember next one is that like your declared dividend sometime is not compulsory that company would pay it. It's optional. However, naturally, company once declare it and approved by the annual general meeting, then they have to pay. That is their ethical decision point, right? So important point is that being the real owners of the company, at first company need to pay the interest to the, let's say, the bondholder, yeah, creditors, then preference dividend to the preference shareholder, and then whatever the earning left, that belongs to the ordinary shareholders of the company. Okay. Now, second could be like your time interest on ratio, which is simply the ratio of operating profit by interest expenses. Higher the time interest on ratio is the good for the lender, we say that, because they are expecting the more time interest on ratio, which shows that borrower's ability to meet interest and the like repayment of the principal on time. And so this is also known as interest coverage ratio, for example. And the next one is that, friends, it could be also used as a risk, credit risk of the borrower. Okay, if your interest coverage ratio is lower, that means borrower's risk, credit risk is high. Similarly, third ratio you could use it to measure the debt position. That is the, simply we can say the debt ratio, which is simply the total debt by total assets. And if we say that debt, your company's debt ratio is greater than 1, what it means? It simply so that you have used the debt above your asset level, which is really terrible situation for your company. But at the same time, friends, let's see the, while the debt ratio is less than 1, yeah, let's see the is the 0.6, yeah, 60%, which indicates that company has used 60% debt sources of funds and the 40% equity to meet its financing needs for the long term investment, friends. Okay, friends, today I just discussed about the concept of that is the deferred tax with examples. And as a financial analyst, yeah, when you are doing research in about the debt analysis, then we could use the debt ratio, debt time interest on ratio, including the uh, debt equity ratio, yeah, time interest on ratio, yeah, debt ratio. Okay, but you, for which you have to review the literature, and so that you would have a better understanding, so that you could do the wonderful research in that area, friends. Okay, friends, these are the things that I would like to share today. If you like this content, please like, subscribe, and also share this channel. Thank you all of you for watching this video. Please take care, all of you. Thank you.